The semiconductor industry endured a brutal sell-off on Friday, April 19, 2024, with leading chip makers witnessing a collective plunge. Industry titans like Intel, down 2.4%, ASML, down 3.3%, and TSMC, down 3.4%, weren't immune, and the carnage extended to chip designers such as ARM, down 16.9%, and memory giants like Micron, down 4.6%. The lone outlier was Alibaba, whose closing price wasn't available, but reports suggested the Chinese tech behemoth also suffered a double-digit loss. Unraveling this widespread decline requires examining a confluence of factors. First, the deafening silence from Supermicro SMCI regarding their upcoming earnings announcement cast a shadow of uncertainty. Investors, fearing potential negative surprises, panicked and dumped the stock, leading to a staggering 23.1% plunge. This jittery sentiment bled into the broader market as investors became wary of the overall health of the semiconductor sector. Beyond company-specific concerns, the industry continues to grapple with persistent global headwinds. The simmering tensions between the U.S. and China, coupled with recent restrictions imposed by China on domestic chip development, are dampening investor confidence. These geopolitical uncertainties raise concerns about potential disruptions to the meticulously calibrated global supply chain and cast a long shadow over future chip demand. Adding fuel to the fire are recent valuation concerns. While ARM's P/E ratio of 65x has retreated from its historical highs, it still suggests a premium valuation. Similarly, AMD's P/E ratio remains stubbornly above its 5-year mean, despite the recent stock price decline. On the other hand, NVIDIA appears to be trading at a discount, with its P/E ratio sitting below its historical average. Intel's P/E ratio, however, has climbed above its 5-year mean, suggesting a potential shift in market sentiment towards the company. To gain a deeper understanding of a company's future prospects, it's crucial to look beyond just the P/E ratio. The price-earnings-to-growth (PEG) ratio incorporates a company's expected growth rate into the valuation equation. Here, ARM's PEG ratio of 1.54 indicates that the market anticipates exceptional growth for the company, justifying its premium valuation. In contrast, NVIDIA's lower PEG ratio of 0.87 suggests a more balanced scenario where its current valuation reflects its expected growth trajectory. AMD and Intel have PEG ratios close to 1, implying that their growth expectations are largely priced into their current stock prices. For value-seeking investors navigating this turbulent climate, Supermicro might appear like an attractive proposition on the surface. The company boasts high valuation multiples compared to its competitor Dell across various metrics: PE, EV/EBITDA, price/sales. However, despite the premium, analysts remain bullish on SMCI, with an average price target that implies significant upside potential from current levels. This optimism is fueled by their expectations of robust sales and EPS growth for SMCI in fiscal 2024 and beyond. While Supermicro's future appears promising based on analyst projections, the broader industry outlook presented a mixed picture during TSMC's recent earnings report. The world's leading contract chipmaker reported strong revenue and margin performance in Q2 2024, driven by solid demand for advanced technology nodes. However, TSMC also threw a curveball by lowering its forecast for overall semiconductor market growth, excluding memory, to around 10% year-over-year. This downward revision suggests that despite TSMC's own success, the industry might face headwinds in the coming quarters. Shifting gears to technical analysis of some key chipmakers, there might be potential buying opportunities emerging amidst the market volatility. Both NVIDIA and Intel are approaching critical support levels on their charts, which could signal potential entry points for investors with a longer-term perspective. Additionally, AMD and ARM are currently oversold on their daily charts, indicating a possibility of a near-term rebound. Micron, on the other hand, is consolidating around key moving averages after recent gains and doesn't exhibit the same oversold characteristics as its peers. In conclusion, the semiconductor market experienced a significant correction on Friday, driven by a confluence of company-specific concerns and broader industry challenges. While the short-term outlook appears uncertain, there are potential silver linings for investors who can navigate the volatility effectively. By meticulously considering factors like valuation metrics, analyst expectations, and technical analysis, investors can potentially identify opportunities to profit in this dynamic sector. Please go ahead by liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.